There are a lot of investors all over in India who want to understand the basics of mutual funds. Mutual funds manage more than 17 lakh crore worth of assets. So there are two broad types of mutual funds. Mutual fund houses collect money, probably 1,000 rupees, 2,000 rupees. Debt-oriented mutual fund schemes collect money from you. We have a category called hybrid funds. What are these hybrid funds? Hi, good morning. This is Chokkalingam Palaniappan from Prakala Wealth Management Private Limited, Chennai. Glad to get in touch with you through this program. Earlier I was doing this in Tamil language. Now I would like to extend this to the English audience as well. There are a lot of investors all over in India who want to understand the basics of mutual funds. So today I will start with the types of mutual funds. In India today, mutual funds manage more than 17 lakh crore worth of assets. Out of that, majorly in debt oriented and to a great extent in equity oriented as well. So there are two broad types of mutual funds. One we call it as equity oriented mutual fund schemes. The other we call as debt oriented mutual fund schemes. What are equity oriented mutual fund schemes? Mutual fund houses collect money, probably 1,000 rupees, 2,000 rupees, 20 lakh, 1 crore, 5 crore, all this money from investors. So they invest that money in stocks or shares as we call. So this is completely related to stock market investment. Say for example, if you invest 1,000 rupees today in mutual fund, that particular scheme takes your money and invests about 50 rupees in Infosys stock, another 50 in Tata Consultancy Services stock, another 40 rupees in State Bank of India stock, another 30 rupees in ITC stock, another 20-30 rupees in Britannia. So like this they divide and invest over 30 to 40 stocks. These are called equity oriented mutual fund schemes. On the other hand, debt oriented mutual fund schemes collect money from you, from the individual investors as well as companies, institutions, everyone, and they invest, or rather they give loan to Government of India or large corporations or even medium sized companies. So they lend. In fact, they do the job of a banker. So they have their own set of due diligence. They have their own analyst. They have their own fund managers to track the things, everything, and they loan it to, as I said, to banks, financial institutions, Government of India, to companies, private companies, and others, and even government companies. And they get an interest amount, fixed income from those investments. They take a nominal charge for their management and share the rest with the unit holders, as they are called in mutual fund. Mutual fund investors are called unit holders. So these are the two broad categories of mutual funds in India. Other than these two categories, what are the other types of funds available? We have a category called hybrid funds. What are these hybrid funds? As the name suggests, these funds invest in two or more asset classes. For example, there is a category called balanced fund. These funds collect money from you and invest up to 65% in equity market related investments, that is stocks or shares, and the remaining 30% is invested in bonds. On the other hand, there is another type of fund called monthly income plans, called MIP. Shortly we call it as MIP, or equity savings fund. These type of funds, they invest up to 65-70% in bonds and related instruments, arbitrage opportunities, etc. And the remaining 30-35% goes to stock market investments, which is shares. So those kind of products, you can call it as an FD plus product. It will give little higher, 1 or 2% higher than FD interest rate, but more stability. Even when the stock market goes down, those schemes may not go down equally, so they are less riskier. So these are the broad categories. So first we saw equity funds, then debt funds, then balanced funds, then equity savings schemes or monthly income plans. And beyond these, we also have gold funds. So the money collected from you is completely invested in gold. And then you have overseas funds. So the money collected from investors is completely invested in the overseas stock market. For example, there are US funds, US stock market related funds. There are Japanese funds available in India. There are funds which invest in Hong Kong market. There are funds that invest in European market. So these are called overseas funds. Then you have ETFs, exchange traded funds. Exchange traded funds are generally managed by fund houses, but they are traded in the stock exchanges. So you can buy and sell only through stock exchanges. These are the broad categories of mutual funds. And probably in the coming video sessions, I will discuss with you more about mutual funds and the intricacies involved, how to invest, what are the risks involved, etc. Thank you.